First of all, thanks everyone for joining. Make sure you raise your hand if you have a question. We will start with a little intro from Tyler telling us about Opendoor's Q4. But make sure you already raise your hands now so we have some questions lined up to discuss and talk about.
Cool. All right. Thanks, Sebastian. And thanks everybody for joining the spaces. We really wanted to do this spaces right after earnings while it was fresh and everyone kind of had questions at the top of their minds. But unfortunately, I couldn't make it because of a work engagement. But we're here now, and I think there's still a lot to discuss, and there really hasn't been much coverage of Opendoor's earnings, which was important for a few different reasons. But I'm just going to kind of walk through some of the highlights that I think are probably worth diving into tonight. And then after that, if anyone has any questions, we can start kind of going deeper into the quarter. So at a high level, Opendoor beat on the top line and missed on the bottom line. Certainly for our own internal expectations. Believe they came in with 7,512 homes sold, 2.9 billion in revenue, adjusted gross margins of negative 3.2%, and homes purchased of 3,427. And on the call, there were some notable announcements. Number one, their chief investment officer, Daniel Murillo, announced his resignation the day before the earnings call. He had been heading up the data and pricing teams for Opendoor for a few years up until that point. And he was going to be, he came from Citadel and before that Blackstone. And he was heading back to the hedge fund world, in which he will indubitably make quite a bit more money. Another point worth mentioning is that new CEO Carrie Wheeler outlined new guidance for cost-cutting initiatives. So she plans to eliminate 100 basis points of cost from Opendoor's operating structure over the next year, and she thinks that's conservative. And she also mentioned new guidance for the third-party marketplace. So previously, Eric Wu had said that they intend for third-party marketplace to be 30% of all of Opendoor's transactions by the end of 2023. We were a little skeptical of that, and she backed that estimate to 30% of transaction share only in the markets that Exclusives is active. So Exclusives is currently active in Austin, Houston, DFW, which are all big markets for Opendoor, but definitely a smaller estimate, more like 4% of total transaction share versus 30% of all transaction share. One of the highlights of the call was they mentioned that List with Opendoor, List with Certainty, had conversion rates of 20 to 25% for real sellers, which was really exciting because it's another way that Opendoor can monetize the transaction in an asset-light, off-balance sheet way. So high profit margins, very similar to third-party marketplace, with the caveat being that List with Certainty is only active in one market right now. And I think last but not least, probably the part that we've been most intent on figuring out is Opendoor's guidance. So for the quarter, Opendoor provided revenue and adjusted EBITDA guidance. Revenue, I believe, 2.45 billion, and adjusted EBITDA, of negative 350 to negative 370 million. So if you back that out, that comes to an adjusted gross margin of negative 5% at the midpoint, which would be about 180 basis points lower than what they posted for Q4. And for us, because we're monitoring all the data, we found this kind of interesting because it's a lot worse than they did in Q4. In Q4, they sold 90% of their sales were from the Q2 offer cohort. That's down precipitously in Q1 and certainly in Q2 as well. And we've seen improving margins. So that's something that we've been monitoring and really poking at and trying to figure out where the discrepancy is. And I think we have some solutions, but not all of it. And it's gonna make for an interesting quarter when they finally do report.
Great. Thanks, Tyler, for the summary. If you have any questions, make sure to raise your hand so we can get you up here as a speaker. One thing that we can double click on while we're waiting for some questions is the new lineup for 2023 for their seller products. Right now, first party Opendoor cash offers are at a record low conversion rate of about 10%. That's mostly due to the offers being bad and the or low, and the current market being kind of frozen in terms of volume. So basically, Opendoor has last year announced that exclusive will kind of fill that gap with better offers because they would list the home on exclusives and get real offers from sellers that they're looking from buyers that are looking at exclusives and from other institutions. That was kind of their plan to get to 30% of their sales through that in 2023. Now, as you mentioned, they kind of backtracked that goal a little bit, mainly due to them saying that the product is not quite in a state yet where they want to roll it out to more markets because that would make iteration a lot harder. If you're only in like one state in 3 markets, you can change fundamental pieces of the experience much faster than if you rolled out to 10 or 20 markets. So that kind of makes sense. And what they are backfilling, or the alternative they want to offer sellers, aside from that, is this list with certainty product, which we heard the first time off in the earnings call. Opendoor had a list with Opendoor product before and was more of like, hey, we connect you to a partner agent and they will list the home for you and it will cost you less than it would cost you with a regular realtor. But they never promoted it. It wasn't ever part of the seller funnel when you come in to get a cash offer. Well, now, because their conversion rate and their offers are quite low because they have to be risk off and expect to hold the home longer. And with the longer holding time, they also have to incorporate the housing price depreciation that might happen during that time. They will offer that seller funnel that they have to partner agents and basically have an alternative to list your home on the MLS with a partner agent and still have the first party offer as a backup. So you get connected to a partner agent from Opendoor, you list your home like you would do with a regular realtor. It's a little bit of a different experience. I guess they also aim for most of the experience not being in person. You don't have to go to like a realtor's office. You just do it from your home. But in the end, if you can't sell on MLS, you can always fall back to the offer that Opendoor gave you, and it will be a discounted offer. So because if a home is listed on MLS and doesn't sell, obviously the value of the home also depreciates. So that's kind of their lineup for this year. There you have the cash offer business, which is currently at a conversion rate low. They will have list with certainty, currently only one market, but likely rolling out to more soon. And then they have the free third party marketplace exclusives business that is currently only available in Texas. And they said they might roll this out to more markets by the end of the year. Do you have any questions? I'm just going to check the Discord. If you have a question or want to chat with us, just raise your hand and we can get you up here as a speaker. Oh, we got one request here. Hey,
Can you
David.
hear me? Hey
Yes.
there. Yeah. So, yeah, thanks for taking my question. So, I guess I was just in light of the Q4 earnings results and what feels like maybe I don't know, like kind of a difference between what's publicly accessible that Datador can scrape and what Opendoor is doing maybe behind the scenes in terms of on their end of things, whether it's, I don't know, like incentives that aren't publicly visible. Do you feel like that poses a problem for the accuracy of the Datador information stream that at least was thought to give maybe investors a competitive advantage in terms of like the crystal ball into the future? Whereas now it looks like there's much more of a, I don't know, like a invisible um, kind of, like there's a lot less visibility. Do you think that that's possibly true moving forward? And if so, um, yeah, kind of, are there any ideas about how to navigate that landscape in terms of investment thesis moving forward?
Yeah, that's a great question. Thanks, David. I can tell you, I can tell you after the earnings result came in, and gross margin, adjusted gross margin came in lower than we expected. Um, we really spent that weekend and really uh, the rest of that week going over the numbers and trying to figure out what the discrepancy was. And we tried it a few different ways. And at first, which I've sort of spelled out, we wondered if it was more of a calculation problem. And every way we did the numbers, they all came out the same. Um, and then, we assumed, okay, maybe it's the non-disclosure states, right? Because we only have visibility into the sales data for disclosure states. So states like Texas, which is a fourth of Opendoor's business, we don't have any data on sales margin. And so even if you assume the worst for those non-disclosure states, the gross margin just doesn't make a lot of sense. And so part of part of what we are in the process of doing is edge case right now. So we're trying to find all the different edge cases that could explain the discrepancy between the margins and trying to use that to create a better model. And I think we have some good ideas for ways that we can get closer, and certainly some proxies that we haven't considered before that on back test already make a few of our metrics more accurate. I can say you look at all the other metrics that we assess for revenue, homes purchased, homes sold. We were, less than 0.6% away from actual on that. So I still think that there's a lot of value in that. And then when you go back to the past 22 quarters that we have data for the quarterly estimates, the gross margin has always been much, much closer than this quarter. So I think that we are seeing a phenomenon right now that probably has a lot to do with Opendoor attempting to sell off as much inventory as possible very quickly and using whatever leverage they possibly can to offload that inventory. And so I think in that regard, it's a little bit of a unique situation, and it makes sense that they were able to achieve such incredible volumes using some sort of incentive or some sort of measure to accelerate those resales. But to your point, we take this very seriously. It's our business to be right, not to be bullish on Opendoor, not to be bearish on Opendoor, just to be plain and fair and right. And so, definitely for Q1, we've already revised our gross margin estimates down for the quarter, with the assumption that there's some sort of incentive structure or some loss of gross margin in these transactions.
And that being said, there's also like limits to what Opendoor can give in concessions, since you cannot just report a number on the sales deed and then actually collect a different number. So there's some rules around the amount of seller credits you can give, or like even if they do rate buy downs for the buyer, there's a limit to that, right? That the lender allows for. It's not going to be unlimited. For now, we probably have to go a bit broader in the range we estimate for, and obviously we're looking to different ways to improve the estimate. We are very accurate in the number of sales and purchases. So I'm pretty proud of that, and that gives that is an important number as well, because like it doesn't matter how much the especially in the rest of this year, like volume will be a really important thing we need to look at.
Thanks.
Right. Any other questions? If you have a question, please request to speak. If you don't want to speak, you can also post us a question in the Discord.
I'll go ahead and ask another question. I don't know.
Sure,
This is
go ahead.
David again. But I guess one of the things that concerns me as an investor, and I'm pretty heavily invested, probably inappropriately so, but I guess one of the things that concerned me was the fact that Eric Wu was absent from the call. I guess I understand that he's shifted roles relative to his kind of, passing over to Carrie Wheeler. And I think there's potentially good reasons, but I guess at least for me, I'm starting to notice some concern about maybe there's a story behind the story. Is the cover story the actual story? Is it that he is dedicated to product? And I guess I'm just trying to figure out or read behind the signs and trying to suss out if there's more afoot than at least the cover story is. And maybe that's just the nature of it being down, and so anxiety or paranoia creeps in. But I think I do know of many companies where for sure the cover story is, we're transitioning, yada, yada, yada. And behind the scenes, there's more turmoil. So I guess I'm just wondering if anybody has any thoughts or ideas about that, because I did find it, I at least for me, it would be easier to stomach a transition if it still felt like, okay, everybody's still here and on board, and his absence seemed to me to be a point of concern. Yeah.
I think that's another good question, David. I think that there are three likely reasons, probably all contributing, that Eric wasn't on the call. One I would say is, at least anecdotally, Eric hates interviews, and he really doesn't like being involved in that, which I think has been frustrating at times. But everyone we know who knows Eric has said that he really doesn't like doing press. He doesn't like really talking to anyone but individual investors. I think that's one. Two, it's Carrie's first call as the CEO. And I think, take that for what it is, but perhaps she wanted her own space, or, to run the show on her end. Hard to know. And then three is, this call was anti third party, right? Like, Eric is now president of Marketplace. The company previously had sort of talked about the idea that third-party Marketplace was going to fix the margin issue by the end of 2023. But really, this call was saying, no, we're not going to do that. The focus is on making the first-party business work. And so what Carrie seemed to want to focus on was getting through the Q2 offer cohort, lowering the cost structure, and scaling the third-party marketplace prudently. But for Eric, I think it would have been a tough call because basically his previous estimate was, called 7 times bigger than it was actually going to be. He was just moved to president of marketplace, and Opendoor just posted their largest loss ever. I think for all of those reasons, it was probably not super exciting for him to get on stage and be be on the call as well. And so those are the guesses that I would hazard as to why he wasn't as involved in this call.
And I assume that currently, what most analysts and investors are also interested in is how Opendoor will survive this. and it felt like the call was all around like laying out a plan that is very much led by Carrie and Dot. I was happy to see Dot there. He's the new chief capital
Agreed.
officer, right?
Yep.
He's definitely stepping up in his role and maybe taking on some of the responsibilities that Daniel Murillo left behind when he's going to leave later in March. So it was good to have them there. One thing I want to see by the end of the year, when focus changes on exclusives and the third party marketplace again, is I would like to have Eric there, obviously, and we'll see if that will happen.
Thanks.
We have Sandeep here with a question, and we also have a question in the Discord we can get to.
Hi
Sandeep,
guys.
hello.
Hi, thanks for taking the questions, guys. So, just to follow up on the last question, so we know we're all excited about the 3P marketplace, and given the earnings call, they have not mentioned anything. They wanted to stray away from it. So, what do you guys? Well, how are you guys planning on getting? Is there a way to get that data that the sale of the purchase from Opendoor is happening in 3P via 3P or via 1P marketplace? Is there a way that you guys are figuring it out, like how will we be able to get data so that we know that this is happening in 3P or 1P? Thanks.
So how we are approaching data collection on the 3P side is we scrape all the homes that are listed on Opendoor exclusives basically multiple times a day. And some of those homes are Opendoor owned, and we see that they're pre-MLS homes that Opendoor first lists on exclusives for 14 days and then they go on the market. So we can observe if those third-party homes were sold by exclusives in that 14-day window or after that. For the third-party homes, we basically see that there's a home that is not owned by Opendoor, and we can see how long it's listed there, and if it goes into contract. So currently we see if a home that is listed goes into contract, and from that point we add this home to an observed list, and we see if this home actually ends up selling. Now, there's a second aspect of this third party marketplace, which involves institutional investors, and if the seller sells to an institutional investor, which historically has been like 10 to 15% of Opendoor's sales, we cannot observe that. So that is a gap in our data, and we will need to rely on whatever Opendoor tells us about the third-party marketplace here. So we only have part of the data that how the third-party marketplace actually works. I would say that it's the more important part. Like, I'm happy they're making sales to institutions, but there will always be like a ceiling on that. While if the third party marketplace goes really well and they have real sellers, real buyers transacting on this marketplace, with Opendoor being just the party in between, that is where the ultra bull case comes in, right? That's what we're really interested in.
Yeah, no, that's good. That's a good starting point. So now, if I have to think about it, now we can get in those regions. Now, I'm not really sure about where they are with the three Ps. I believe there are 3 cities or 3 states. Uh, so we can have the inventory that Opendoor owns in those states, and then the listing that are off those lists. So that could be the 3P part, and out of those, how many close or goes into contract and then end up getting closed, we can get some sort of a percentage in those states. No, am I missing anything? Sorry.
Yeah, we could get the percent of homes in those markets that's selling via the exclusives marketplace. And this is a number, at least for the first party homes that list on exclusives, that we have on the data dashboard. On the third party homes, we don't really know what the total amount of people is that go through the funnel. We just see which end up listing and how many of those go into contract and how many gets sold. I mean, they're not at a huge volume right now of homes they are listing, so it's relatively small. But this is one thing we will be looking at and reporting, is like, what is the conversion rate from being listed to going into contract and being sold, just like we have the data as well for the first party homes.
Okay. Okay. Great. Thanks. And just one follow up on that. So, what did you guys think? I just want to get your opinion on, how Kerry went on about, okay, in 2024 we'll have a 10 billion from 1P, and then adjusted net income positive, and she's only looking at that 1P marketplace, and she's not even summing up anything coming from 3P, right? What are your thoughts? What were your thoughts around that?
Yeah, I mean, I think even in her own words, it was a conservative estimate um, regarding her expectations for 2024. I think both Sebastian and I were a little surprised about the revenue run rate guide, given that they're far above that number for both Q4 and Q1. In terms of top line guidance. But then again, it seemed like she was saying that they really don't intend to acquire very many homes in the near future, which obviously is going to bring down revenue. But I think if they actually are going to get to 30% market share of the third party marketplace in the markets that Exclusives is active, as I said earlier, that would be 4% of overall transaction volume if we're just doing DFW, Houston, and Austin. And they said that they're going to add more markets probably throughout the year. So, I would expect that number to be at least around 10% plus by mid 2024. And if List with Opendoor has a little bit more traction and is released in additional markets, it would be surprising for those to not contribute to the bottom line in some sort of meaningful way.
Okay, thank you guys. Thank you.
Hey, Tyler and Seb, thanks for taking my question. Obviously, we want to get through this phase and put the Q2 cohort behind us. But my question is like, what if mortgage rates go to like 8%, and then let's pretend that all of the markets where they have Q2 cohort inventory, if the prices drop, let's say another 10 to 15% this summer due to the mortgage rate impact, what would be the impact to Opendoor's balance sheet, and can they get through this period? Thank you.
Hey, thanks for the question. I think yeah, it would be concerning if we got into another situation similar to the summer of 2022, I think Opendoor probably wouldn't survive something like that if they were buying at the same volume that they were, in that summer. I think I posted a tweet the other day that in May, Opendoor bought 9 times as many homes as they did in January. And so I think there were a lot of issues that led to Opendoor having this year-long plus drag on their business, on their cash, and their margins. I think one of them was it was a historically hot market that accelerated basically into a brick wall, right? And so that's very different than today, which we can talk about sort of the macro backdrop of today, but it's a very different environment right now. Two, they were buying so many homes at the time that the market crashed. They're not buying practically any homes right now. And I think when it comes to the Q2 offer cohort, we expect Opendoor to be, in the 95+% of the way sold, give or take a few hundred basis points of the Q2 offer cohort by the end of Q2. And we're in March right now, so that's just a few more months away. And so the overhang for them, the total inventory that they actually have on their balance sheet right now is pretty low. So they are positioned unquestionably better right now for any sort of dislocation in the market. That's sort of the positioning part. The second piece is the macro, right? And like what is currently going on in the market. And, mortgage rates are already above 7%, I believe, or at least they were recently. So 8% doesn't seem so far away. Certainly wouldn't be a huge shock, right? But I think what's currently going on in the housing market is even though mortgage rates are up, inventory supply just continues to drop. And so I think that's a huge buffer for prices, right? Because there's just so few supply and demand is actually the axis that's being favored right now. So, could we be in another situation where housing drops and quickly? Sure, but it just seems like that's kind of already happened. And certainly the delta, I think, couldn't really be much larger barring some sort of, black swan event. I think the big run up to the hottest housing market to suddenly having a market where no deals were done, that's really what drove a lot of the collapse in the price of Opendoor's equity in these homes.
Yes, thank you. Appreciate the answer.
And I guess add to that, Opendoor did have quite high margins at the end of Q2 last year. So they were preparing they had higher spreads and were preparing for something to happen, but not what actually happened. Now if we look at the spreads or the embedded margin, this is how we kind of observe that. For the newest cohorts, it's like another magnitude difference, right? They are really risk off, and the purchases they are doing, they make sure they have enough buffer there that even if prices would drop 15%, things wouldn't go as bad as they did last year.
Right. Like you look at if you back out the contribution margin before interest of homes that Opendoor purchased beyond August, so anything from September and beyond, the contribution profit margin is north of 10% in most cases. I think as a whole, it's certainly around that number. So it kind of gives you an idea that if this event didn't happen, or if Opendoor continues operating at this low volume, they can certainly do it at very high margin, even in a down market.
See, I think that's where I'm a big bull, right? But my biggest concern is in order to hit the $10 billion run rate, so it's 2.5 billion a quarter. They gotta sell roughly, let's say, 7,500 homes a quarter. they gotta really be offering like 15% less because they gotta account for the cost of borrowing. At like a 15% drag, I don't know if I would sell my home to like Opendoor, right? And I am a bull. So I'm just worried that if it does go to like 8% and prices do, let's say, drop like another 7 to 8%, and then the offers, right, if the offers are ridiculously low, I don't even know if they can transact 8 billion, 8,000 homes a quarter for like another, let's say, 3 to 4 quarters, and that's just going to impact their balance sheet quite a bit, right? So they may have to either raise capital or I don't know. There's a lot of uncertainty, and I'm just like a little bit worried.
I think that's a totally fair concern, and I think you bring up a lot of great points that are reasonable for the bear case. I will say, I think one of the things that we've seen for Opendoor is that they can actually transact in volume, and sometimes it's unclear where they choose to transact and why. But I will say, situations like the Zillow partnership, as that's turned on in more marketplaces, that's a much broader funnel for purchase acquisitions. It's just a much larger aperture of home sellers that are walking through Opendoor's funnel, and I think that gives me a little bit more comfort. I mean, the fact that it's only in 2 markets right now is unfortunate. And like anything for Opendoor, the more markets that they're active and actually active, not just like on paper active, but where they're transacting in volume, the more that happens and the more that's divorced from a few concentrated markets, I think the more insulated Opendoor is from these sorts of situations. But yeah, to your point, I think in another really bad down market, anyone who's transacting in real estate is going to do poorly, but especially Opendoor, because they're trying to recover. They're trying to get back on the saddle. They're going to make it out of this current situation, but I don't think they have the capital to get out of 2, right? And so I think it's going to be important to watch how they're navigating this, and I'm sure your concerns are part of the reason why Opendoor hasn't begun to meaningfully accelerate purchase volumes, because they want to make sure that when they do, they're ready and they have trust and confidence in the data.
Oh yeah, I know you wanted them to acquire more homes, but yeah, I think they should be conservative. Just get through this period and hopefully see the other side. That way they can get back to where they were. Anyway, thank you. Appreciate the answers.
Hey Art,
Hey.
do you have a question for us?
Yes, I do. Thanks for hosting this call. I had a question specifically around Founders Fund, with Keith Raboy being really the catalyst for Opendoor, and then he expresses a concern with the board of directors. He expressed his concern with the move to a wartime CEO, not in those specific words. And being Founders Fund, right? They back founders, having the founders step down. Have you had any updates on how much influence Founders Fund has on the board of directors, and any direction that Keith Raboy may still be giving Opendoor? Because their advice is kind of priceless at times, especially during moments like this.
So Founders Fund doesn't have a board seat anymore. Founders Fund never has had a board seat on Opendoor. I think it was through Khosla Ventures that Keith was on the board when he left the company, and then Khosla gave up the board seat, and so Keith had to step down from his board seat as well. And to what extent Keith has impact on the company is really hard to tell. I think the last thing we heard from him on Twitter was at the end of last year before Kerry took over as CEO, he was involved in some advisory role. At least that's what he said on Twitter. He is not involved in the day-to-day. We know that.
Right.
He's doesn't have any special insight there.
So I was just curious if we knew if any of the board of directors that are on the board right now have ties to Founders Fund, not like directly from Founders Fund, but if they're Founders Fund friendly. The latest tweet I saw from Keith was almost indirect, but it looked like very direct on Opendoor, where he was again pretty bullish on the $20 price. And that was, I think, about 3 or 4 weeks ago. Thank you.
Hey, Art. Yeah, I mean, it's a good question, and obviously, Keith has accomplished quite a bit in Founders Fund as well. From what I understand, Eric and Keith still interact, and they're still friendly. And Eric has a board seat. Obviously, doesn't have the CEO title anymore, but is still president marketplace. But yeah, I think this is a tough time for the company, and that sort of advice and experience would be priceless, as you said.
Thank you.
And I think the other board seats that Opendoor has with GGV Capital and I think it's Excel Ventures, they're not founder unfriendly. Like we don't know what's happening in the board. Nobody tells us. But I don't think they would like push out a founder without like them having a say. It just feels like it was more of a mutual agreement that Kerry should take over as CEO. But who knows? We might know in a few years. Any other questions? We have one question from. Oh, sorry.
Oh, no, you're good. Yeah, thanks for hosting this space, guys. It's always, a great resource. But I think you touched on it lightly, but just to reiterate and make it clear, the 30-year mortgage rate's at, it's over 7% now. And I can't imagine a lot of people are selling their homes, especially if they have a lower rate locked in. And, of course, fewer will be able to purchase, at the current rate. And do you forecast the iBuyers having difficulty finding quality properties? And is there a possibility that Opendoor could run out of homes per se if rates continue to rise, assuming they want to sell around 7,500 homes a quarter?
Yeah, I think that definitely could happen. I think we're in a situation where the current expectation for homes sold in 2023 is like 50% lower than previous years, the most recent previous years. I think we're kind of at a standstill with residential real estate right now, and the higher you raise mortgage rates, the less affordable these homes get. I will say that there are some ways that Opendoor can try to have elevated volumes as compared to the rest of the housing industry. And we saw this in the fall of last year. After home prices started to collapse and mortgage rates were rising, Opendoor began buying smaller homes or cheaper homes, right? Cheaper, at least on a year-over-year basis. So they moved from buying on average $350,000 homes to buying on average $300,000 homes. And I think on the surface, it looks like, okay, they're widening spreads, right? They're trying to insulate their margins. But on a per square foot basis and on a how many bedrooms, how many baths, how many pools, if you look at all those metrics, the homes were cheaper homes, right? And I think that kind of goes along with the idea that there's probably the median home price in the United States, or at least what's most commonly, maybe we'll call it the mode, what's most commonly transacted when mortgage rates rise has to be a cheaper home, right? Because that's going to be the place that people gravitate towards because that's the home that they can afford because they've lost buying power. I think that's potentially an avenue where Opendoor has been able to have elevated volumes relative to the rest of the market, certainly in a market by market basis. But yeah, if you get in a situation where mortgage rates are 8-10% and homeowners are like, I have a 3% mortgage rate, I'm not going to move, right? Like those are situations where people just stop moving, right? And so you kind of get into this more desperate situation. I think that would be bad for anyone in the residential real estate industry. It'd be bad for agents. It'd be bad certainly for Opendoor, and I think it would be really challenging for consumers as well.
We have a question here, or two questions from the Discord. Let's start with the second one. Jacob is asking, why do you think Las Vegas market in particular is performing so poorly? It seems like even the post Q2 cohort is performing below the market, below other markets. Do you have an opinion on that, Tyler, on the Las Vegas market?
Yeah, I think Las Vegas probably did a head fake. So I think Las Vegas probably had a false bottom in home prices. And so even when Opendoor started buying fewer homes at wider spreads, Las Vegas just kept going down. I think San Francisco did a similar thing. Just the nadir or the trench of the price valuation was lower than they thought, which is why in the worst markets, that's the phenomenon that we've seen is that even through December, in some cases, the margin on these cohorts of homes are still well below average, which means that it's going to take longer for them to dig out of those markets. I will say Phoenix, it looks like they're, at least in their most recent cohorts since like September, they're definitely righting that ship. It's just because they had so many homes at the time that the market crashed, it's just going to take more months for them to get back to normal.
Yeah, it's interesting that, especially on Twitter, Las Vegas has a lot of ice, and
It's that landslide.
Yeah. Well, the good thing is Opendoor is in more than 2 markets and more than 2 states. I think market expansion that they did in the last few years really is helping them out here. And the second question was, the revenue projections for Q1 are between $2.45 billion to $2.6 billion. From the data he's seeing, he seems to be collecting his own data. It seems like revenue should be a lot higher. I guess we maybe Tyler, you can go into what we're seeing for Q1 in terms of revenue or homes sold a little bit. But one thing that is important to note, it came up multiple times in this call today, is the $10 billion revenue run rate that they were talking about. I think one important signal that they're sending us here by telling us we will be at that revenue rate by mid 2024 is that we should probably not expect that revenue run rate for H2. It's very likely that we will be way below that, and it's because of the depressed acquisitions that we are seeing, right? So Q1 revenue, Tyler, what are you thinking about Q1 revenue?
I mean, I'll say since Opendoor has been public, every single time that they've guided for revenue, it's been conservative, right? I don't think they've missed on the top line in any material manner once. So we expect them to almost always be very conservative on their revenue guidance, and that's I mean, Carrie Wheeler was CFO that entire time, right? So now she's CEO. I don't think that there's going to be any stylistic changes in the estimates on that account, because I really doubt that Eric was in charge of that. I would say the thing that shocked us most from the guide was not the revenue, but was the margin guide, right? If you back out, negative 360 adjusted, negative 360 million adjusted EBITDA, the negative 5% adjusted gross margin that you get to is a shocking figure relative to their Q4 performance, relative to the data we're seeing for Q1, and I think it was under discussed on the call. No analysts had any follow up questions for it. I think that's the area of contention where I feel like I'm constantly just staring at those numbers, trying to make sense of how that could possibly be. But the revenue, I mean, it's conservative, but not outside the ballpark for their prior quarters.
All right, let's do one more question and wrap it up for today. We have Gerardo joining us as a speaker. Do you have a question for us?
Hey, Sebastian and Tyler. I got a question, just very general, on the third-party marketplace. Could you guys talk about what's the advantage that Opendoor has with the position that they're in, and how it would be difficult for a competitor to get into the same space? I mean, the idea that I have for the third-party marketplace is that you're getting rid of intermediaries by not having a realtor on the sell side and on the buy side, and you just have Opendoor that with scale hopefully amortizes costs among all the transactions that they do. And then I think the idea that I have is that if you're a seller, they'll help you with the whole repair process and simplify preparing the home for the buyer. And on the buyer side, I guess they help with guaranteeing the transaction and making it smooth and hopefully digitizing all the paperwork. Do I have the right idea there?
Yeah. Hey, Gerardo, thanks for the question. I think it sounds like there's maybe two parts to this question. One is, what's the unique advantage that Opendoor has in building a third-party marketplace relative to peers? And then also, what's the value proposition for the seller? So I'll start with the first one. I think what's unique about Opendoor, that I think what makes it so that Zillow, for example, couldn't build this, is that Opendoor is offering a price for every single one of the homes that are listed on this marketplace. And so no matter what happens, no matter if Opendoor can't aggregate any more offers for these homeowners, they always have an offer in their back pocket, which is worth something. And I would argue worth something significant, right? Always knowing that you can take an offer no matter what, I think gives you a lot more leverage in the transaction. And so the reason that the Zillows can't build this third-party marketplace is because they exited iBuying. And perhaps OfferPad could build this as well if they have aspirations to do so. But you certainly need a decent set of or decent scale to make this kind of thing happen. Certainly in the markets that you're operating. And so perhaps OfferPad could do this in some of their larger markets or as they scale themselves. But I think to answer the second part of your question is, what's the value prop for the seller? I mean, Opendoor's third-party marketplaces, if you're a homeowner, you send in pictures and information on the home, and Opendoor just goes out and gets offers for you, right? Including one from them. And Opendoor acts as your realtor, and you pay 5%, but the current model is that Opendoor gives you back 2%, so it really only costs 3%. Normally for the home seller, it's 6 to 5%. So there's a lot of value in that, but I think this is what home selling should be, right? Like home buying is different. Home buying is a much more I've said this before, selling is finance, buying is romance, right? Buying your home can't be broken down into something as two-dimensional as money, right? And that's part of the reason that realtors have said that Opendoor needs them to make their business model work. You just need more to make the buying experience magical. And so just making it all offline, I think we're a few years away from that, certainly. But the selling part, it's just finance, right? It's just, I want to get as many offers as possible, and I'm going to choose the best one, or I'm going to be able to sell to the group that I want to. And Opendoor has all of these eyeballs from home shoppers. It has all of its institutional partners, and so it can accumulate all these offers for these homeowners, which creates a really great value proposition because nothing else exists like it. And it's easy, it's hassle free, it's certain because you always know you have an offer. And I think that's why we're really excited about the third party marketplace if and when it scales to the size that we think it would be.
And I would add to that Zillow is very dependent on realtors in their business model and on MLSs, right? Zillow had many fights with MLS providers in the past that tried to pressure them into certain directions. And obviously that would probably not go much better if Zillow would try something similar. Or if they would try to cut out the agents that are financing the whole company with their ad dollars, right? It's a difficult position to be in as Zillow if you want to change the system while you're taxing the system currently and how you sustain your company.
It's the classic counter positioning moat, right? Like Hamilton Helmer's counter positioning moat. If Zillow tried to compete or tried to create the same product, it would be cannibalizing its golden goose.
And I guess we could go into like more detailed, like one thing that I think a lot of people underestimate is how advanced Opendoor's pricing engine is. And I know a lot of people will laugh now and point to the losses that they made last year. But the important difference is if you're pricing for a marketplace, you don't have to forecast 3-4 months in advance and like kind of back out the actual cash price that you can give a seller while you take the risk. No, you just price the home as if it would have been priced right now. If it would sell right now, and that's the price that is on exclusives. That's the price where the buyers see through the third party marketplace, and they're enormously good at that, and they have a lot of proprietary data that nobody else has because they've inspected millions of homes over the last 8-9 years, and they've collected more data on that than probably anybody in the US has on real estate or residential real estate, and that is really worth something, and that should result in a better experience for buyers and sellers in this third party marketplace as well. All right. Unless we have another short burning question, I think we can wrap it up for today. Tyler, do you have any closing statements for us?
My closing argument. Yeah. I think, well, one, I appreciate you all being here, and your questions. I would say globally, this is not the end to 2022 that I think any of us who are constructive on Opendoor were hoping for. This housing dislocation, the downturn, hurt. It was a deep cut, and I think a lot of Opendoor's original thesis has been dented in, and I think there's reason to question what's going on, right? And they've lost a lot of leadership at the top. There's been shuffling in the organization. There's been layoffs, and in the macro situation is tough too for anyone in technology, but particularly residential real estate space. All that said, the metrics that we're seeing every day on Datadoor show us that the company is getting better week on week, and they have been since mid-November. And so by that, I mean margins. Margins are improving. It seems like even embedded margins of their Q2 cohort inventory are on the rise as well, either because they've sold off the worst of them or because there has been a little bit of HPA early in 2023. But either way, it seems like they're improving, and that they're going to get through this with the current cash position that they have. And certainly all the comments by management suggest that they believe that they are going to get through this. I don't know what that means for the stock price. Obviously, that's not my job, and I wish I could do that, but I can't. But it seems like currently today, Opendoor is still trading like a company that's not going to make it. And Sebastian and I feel otherwise. And it's difficult to tread that line, especially publicly, because we want to be as honest as possible about the data. We want to be honest about when we're disappointed and when we're excited. But hopefully you can kind of see that at the very least, we're trying to be honest about it. And we are doing the best we can to make sure that the data that we're presenting are as accurate as possible. But we do believe in this company and the long-term opportunity that they're trying to meet in residential real estate, which is a very, very broken industry.
Right. Thank you, everyone. Make sure to subscribe to the Datador Front Porch podcast that we do bi-weekly now on YouTube or on Spotify. And if you just want to ask more questions or follow all the research work we do, make sure to join our Discord on datador.io/community. And we'll see you soon. Bye.